Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And welcome back. Another record-setting week. You know, that's kind of funny that they say that, because it's not by a lot. Dow's actually leading the other indices right now. And, by the way, the Dow's 30 stocks, not really representative of the entire stock market, but some really big, important names in there, and it's nice to see that they're doing well. Looks like it's closing in on 20,000 here without much further ado. But, you know, before you take a look at that, you know, it was actually, the Dow bounced back actually faster than the S&P 500 did a little bit, a few months. So peaked out back in 2007 around 14,000. And here you are, how many years is that later? 9 years, and it's at 19,000. So if you had something that was at $14 and it's at $19 now, after about 9 years, is that a huge return? Nope. It's okay, but better than a loss, that's for sure. But it's not a huge return. That's one of the things that kind of cracks me up about this whole process. Is you listen to the news, boy, just listening to the headlines, that would be a really tough way to manage money, an incredibly difficult way. As the headline, they're just trying to get your attention. It doesn't really matter how they get your attention, just as long as they do. And the S&P actually peaked back in the year 2000, and it's only up about 40% since then. 40% since the year 2000 is not a big number. So that's one of the things that I kind of wanted to talk about today. You hear all this stuff on the media. How do you put it in perspective? How do you make sense of a lot of that? And the bottom line is you actually have to know quite a bit to be able to take what they're saying. Otherwise, you'll just constantly be at the mercy of the media, and the media swings its opinion more often than Donald Trump on his presidential campaign. So it's a difficult thing. I mean, there's a lot of stuff that you've got to become familiar with. And most of it's not actually as complicated as people would lead you to believe. In fact, right on the Randall Forsythe, he's the guy that writes the beginning column in Barron's. He's got some pretty interesting insights there, and he's actually quoting somebody else, another academic type. Actually, this guy's a senior vice president of research for this BCA research, and the guy's got a lot of interesting things to say, makes some interesting observations. A lot of the things that he's talking about, I happen to know you can't possibly know what the answers are to, but he's not paid to be right. He's paid to be giving someone his opinion. That's another thing that you kind of have to deal with. I can remember talking to a client once, and he said, "Well, what do you think about XYZ?" And I said, "Well, I think this is probably going to happen." He goes, "Well, what happens if you're wrong?" I said, "Well, you got to get used to that." And he thought that was really, really funny. He was laughing. He goes, he was thinking that, oh no, it's the end of the world. No, it's not like that. In fact, in investing, you can and will. You'll make lots of mistakes, tons of them. But the great thing about investing is stocks move so far in such a short time period, you can make that money back. So don't worry about it. To try not to make the aim for perfection is the enemy of profitability. You try to be perfect, and you're going to end up not making much money at all if you don't end up losing a lot of money. So you got to build that in. And those kinds of things I know the average investor doesn't hear because my show is very small. It only goes out to a little part of Northeast Ohio. The other guys don't know. That's all I can assume is that they don't know. Because if they did know, somebody would write something about that at some point in time. And reality is, it is, there are some academics coming out doing a bunch of research, talking about the same things we've been talking about here for 35 years now. And see, they have the money to buy those, subscribe to the $100,000 a year databases just to use the data. And then you have to hire a programmer that knows how to program. Or they could have just asked me. But they do all that to get the academic research, the data and the statistics to back up those things that typically I think are kind of common sense. I think it's highly unlikely that interest rates go up a lot, although they could. I've been thinking about that recently. The Fed hasn't raised the 10-year Treasury rates. They haven't raised interest rates nearly as much as the interest rates have gone up by. So the market is actually doing it itself. And knowing when the market's going to move, if the market were acting rationally, it would have moved a long time ago. But so rates could go higher. Is it likely? I don't think it's likely, but I think it's a lot more closer to 50-50. I don't know if you've listened to this show at all. I've been in the 95% or better camp that rates wouldn't go higher anytime real soon. And ever since I've been saying that, they've been stuck in a range of 2.5% to 1.5% on the 10-year Treasury that's about 8 years now. And looking at the data, looking at what's happening in the economy, unemployment probably going to, we're probably, the way things are headed, we could have inflation, and a lot of it could spill into the labor market. And when you get wage inflation, then interest rates may rise. Now, don't run out and put all your money in cash waiting for CDs, because we're in the 50-50 camp. I think, and that might even be generous. I may be being generous when I say there's a 50% chance that interest rates go up somewhere in the next 4 to 5 years. You still have $14 trillion worth of debt, and a government that wants to increase rates by 1 or 2%, you're looking at $140 to $280 billion in extra expenses for a government that's already running in a deficit and has a significant amount of national debt. Doesn't mean they can't or won't. It just means it's probably not the smartest thing that they could do. But then again, when you look at all the alternatives, it may happen. You might get a 3 or 4% CD over the next 5 years. Yeah, that's still a tough way to make money. 4% on $1 million is only $40,000, and you got to pay taxes on that. Think about that for a second. Right now, stocks, the earnings yield, when you divide the cash that the companies that make up the S&P 500 are making, when you divide the cash by the market value of the companies, it's over 5%. So treasuries are still overvalued relative to stocks, and they've closed the gap a little bit, not much. Yeah, they were a lot more overvalued, and if you looked at the treasury, the bond market, it's gone down. Here's something that you can look at, by the way. There's an ETF that invests in long-term treasuries. The symbol is called TLT. It peaked out around 141 in July. So even before the election, it was already down quite a bit. Now it's at 117. Now this fund is buying long-term treasuries, long-term government bonds, and it's down 18% in 6 months. So it's buying long-term government bonds. A lot of younger, newer investors, especially the millennials, don't understand why bond prices will drop when interest rates go up. And in this case, bond prices dropped, causing the interest rates to go up. They don't really cover that really well in an undergraduate, in a bachelor's degree economics class. I know because I took them. They don't cover that very well as to the dynamics behind that. So when interest rates go up, it's because bond prices are dropping. And a good kind of a benchmark to see how long-term high-quality bonds are doing is just look at the TLT. Get online somewhere and pop that in. You can go Google it. It'll bring you right to the page, and you can see the chart. So you got an 18% loss, which is kind of wild, though, because it's actually just back to where it was in 2015. So what that, and that's the way the market works, by the way. It's cruel. So 2015, it bottomed out around 117, 118, goes all the way up to 140. People, yeah, all right. And then it takes it away. In the meantime, 2 years have passed. That's cruel. Very cruel. But kind of how markets operate. The good news is there are lots of opportunity there. And so far we've been kind of alluding and talking about the risks that are out there. There are also got a lot of opportunities in this market, and I think it probably has a long way to go. And I hate to make a short-term prediction because the short-term market predictors are only there to make the weather forecasters look good. Yeah, because it is incredibly difficult to get that right. But there are certain economic conditions that show up that are meaningful. Unemployment rate dropping low, that's meaningful. Housing prices going up, that's meaningful. Selling over 17 million cars in a year, that's meaningful. These kinds of things, and it is kind of common sense. Why don't you know about that? Because nobody has time to look into those types of things. So you can find different sources on the internet for free. But anyway, GDP growth, the growth rate in the entire country. Also positive, got above 3% I think it was last month or last quarter. First time in 8 years. That's meaningful. Why is the stock market doing so well? Well, some of the things that they're talking about, if you cut taxes and increase spending at the same time, that's meaningful. It'll work. Cut taxes, increase spending, you will create jobs in America. Now, the trick is doing it so that you don't overheat the economy, you don't start inflationary pressures that get up so high that they start to raise interest rates. Now, that cycle typically takes about 4 or 5 years. In the meantime, markets should be very good. They should be very strong. Barring some unforeseen circumstance, if we stay on the path that we're on now, if Trump stays true to even half of what he said he was going to try to do, that's going to be meaningful. And it's going to present opportunities to those people who are aware of them. In fact, we're going to be talking about that at 7:30 on January 12th. Go to my website. There's a seminar. It's free. 7:30. Now at 6:30, we're going to be doing an individual stock talk. I've been doing these on and off. This is going to be a regular part of these meetings. So at 6:30, we're going to talk about individual stocks, and we're going to talk about long-term trading, which is kind of an oxymoron, by the way, but you'll find out why if you decide to show up. But we're going to talk about individual stocks at 6:30. We're going to go for about 45 minutes, and then we're going to talk about new year, new president, new risks and opportunities. And I'm extremely optimistic, more so than I've been in quite a while. I got two fears. And I'll just tell you the first one here. I'll save the second one for the seminar. But the first fear is that things get too good too fast. If the market goes up in anticipation of everything that's already developing and gets overpriced, that's not going to be fun. Okay? It'll be fun on the way up. That'll be a lot of fun. But at some point in time, you're going to have to cut back and rebalance your portfolio and reduce the amount of exposure you have to stocks. That's what you're going to have to do. And that's never fun because the general public has no idea how to do that. They have no idea how to do that. In fact, I just cut a little video. These are going to start showing up on the website about returns. And this is just a short-term return and how that can affect people's perception over an extremely short time period. You get a fund that's gone way up over the past year, and this is kind of the example that I used in a little video. Videos are super short, by the way. I want to try to put these out in the future under 90 seconds, and we're going to talk about one topic that's important. So by the time I get these done, I'll probably have a couple hundred, but actually probably 30 or 40 because there really aren't that many super important topics that you really need to know about. A lot of other ones that people say are super important. They do that all the time. That's the other thing about the modern media. They cry wolf constantly. And it does get boring, and actually it gets to the point where it's just annoying. And trying to read a paper and trying to pick out the true stories from those that are significant is a lot harder now, because you got a lot of analysts out there and journalists that are writing, and they've got to sell ads, and they got to fill pages, and they got to get you to look, and they get paid per clicks or paid per impressions on the internet. That means if somebody shows up and sees it, that gets counted, and the advertisers on that page get charged. But anyway, bottom line is I just talked so long along those things that I'd forgotten what it was. New risks and new opportunities, actually, is what we were talking about. And overvaluations. We're not there yet. When we get there, I'll let you know. Listen to the radio program. I remember what I was talking about. So if you're looking at mutual funds and you're looking for the best performers, and that's generally how people do this. They go and look at performance, and then they look at the fees. And by the way, I can save you that effort. The performance already has the fees factored in, so you can throw that out the window. If the fund goes up 75%, and that's net of the management fees, so don't worry about it. Unless you're comparing two identical funds, then it's important. But if you're not comparing identical funds, performance is the first issue most people look at. Got to look at it the right way, though. The vast majority want to put their money in the one that's gone up the most over the past 12 months, because they're not aware that a good 1-year performance will inflate the 3-year and the 5-year performance. So if you got a really good 1-year performance, it can make the 3 and 5-year numbers seem a lot better than they are, and they may not have made any money, or could have even been negative during the 3 and 5-year time period. So once you've identified the best performers, that's just the beginning. That's not the end. And unfortunately, for the vast majority, 19 out of 20 individual investors, that's where they stop. They stop. And for those that, the 5% that keeps going, the next thing you look at is fees. That is such a waste of time. Again, the performance is net of the fees. So you really don't, you don't have to look at that. It's not going to make any difference unless you're investing in identical funds. If you're comparing two identical funds, like a Spider, that's a SPY, or one of the other market cap weighted indexes out there that's identical, that also invest in the same stocks, then the fees matter. I hear the music. That means I have to take a real quick commercial break. You listen to Bill Bullington right here on 1420 The Answer. Stay tuned. I'll be right back. And we're back. I remember that song. What does that have to do with finance? Let's see. Pretty wild. Anyway, hey, I got a question somebody mailed, or actually it was a comment, and asked my opinion on this. There, big talk about derivatives in the banking system coming back to haunt us again. I hear that all the time. By the way, the derivative means derived from. There are lots of types of derivatives. In fact, when you buy mortgage-backed securities that are backed by Ginnie Mae or Fannie Mae, those are backed by the government, and it's considered a derivative. They package mortgages together, and then they sell them. Well, that's a derivative. So is an option on a futures contract. That's considered a derivative. So those things are two entirely different animals. And in the media, when they talk about, banks dealing in derivatives, well, yeah, all the mortgages, they're considered a derivative. So, and the journalists that write that stuff, I'm going to give them the benefit of the doubt, and I'm just going to assume that they just don't know any better. Yeah, because if they knew better, they would specify what types of derivatives the banks are going in. But my hunch is that a lot of them do know that mortgage-backed securities, which are generally safer than a lot of others, are especially if they don't have collateral default obligations on them, another derivative. That is, that is the banking system. The banking system is largely made up of derivatives, but you've got to define them. Some derivatives are relatively safe. A lot of them are just lottery tickets, literally. They're bets, they're gambles. Okay, so you got to specify that. And none of the there's no way a journalist is going to attempt to explain what types of derivatives he's talking about in an article that you're reading in a newspaper. Nobody will make it through it. They'll all be asleep halfway through the article. Okay. So they need to define that, but they really can't, because the topic that they're talking about requires so much time, effort, and energy, and then nobody would read it anyway. So that doesn't sell ads. So, yeah, I hear that, and I understand. I get the whole thing. Also asked me about the movie The Big Short, which I found very interesting. If you haven't, there are lots of it that if you're not involved in financial services industry, it may not make certain sense to you. They have to kind of dumb it down for the general public because it's not what you do. I mean, these are occupations, and the stuff that they're talking about is incredibly complex. And the only thing that I thought it was a great movie. I liked it. What they didn't show was how many people had made the same bets as the investors who had profited from the collapse of the mortgage market, because he didn't have enough money to wait out the time that it took for that collapse to happen. That's another thing with derivatives. You're actually buying time. You're betting. It'd be like betting on the Browns to win a Super Bowl. Okay, how much money do you have, and how long is your life expectancy? Maybe one day the Browns win a Super Bowl. And maybe you bet $100 a year that they win the Super Bowl. That could be a while, And that's the same thing that was happening in that market. People were making these bets they were using derivatives to capture a profit from other derivatives. I don't know if that helps at all, but anyway, I got to take a real quick phone call. By the way, you can call us in 216-901-0945, 216-901-0945, and I got Jerry.
Good morning, William.
Hey, how you doing?
Good. Sounds like you have a bit of a cold this morning.
Yeah. I got it several weeks ago, and it just hasn't gone away. So.
Yeah. Well, I wish you well with that. Hopefully it'll
thanks.
Go away quickly. What do you think about GM? GM has had a nice run up, but how much more gas is in its tank?
I don't know. If you look at the chart, it looks like a breakout stock. I mean,
yeah, it does.
Yeah, it does. It's a classic breakout stock. It doesn't have a perfectly formed handle, but that's not necessary anymore. By the way, William O'Neill used to stick really closely to that. But by the way, I wanted to apologize. I felt like I was a little rough on the last seminar. I'm really sorry about that. My tone of voice sometimes, I get so excited. I know, and I listen to what I sound like later on. I'm like, oh, geez, So I'm really sorry if I offended you at all at the seminar, because I really appreciate you calling and showing up, and you ask good questions, and you really do improve the show. So
no, well, that's very kind of you to say, but no, it's just because of your enthusiasm on the subject. I never take anything personally.
Oh, that's good.
Okay,
I'm relieved.
Okay, I'm sure. Okay. So what do you think about GM?
Well, it's been in the dividend model for a very long time. The dividend model's had one of the best years it's had. I mean, it's unbelievable. So that's why I like that model so much, because it'll buy those names like GM and Ford. Bristol Meyer was in there. The names on them are really high quality, old school stocks. Mm-hmm. And one of the things that tends to work well over time is value investing. It'll aggravate the dog out of you when the market, if GDP growth gets back to 3.5+%, the stocks that will do better will be your smaller mid-cap stocks, typically the ones that are the ones that are
the Russell.
Yeah, and the ones that are growing fast. Right now, you got a whole bunch of old economy stocks that are actually leading the stock market. That generally will happen for a while, and it could happen for a couple of years. And at some point in time, that will start to shift over into small and mid-cap stocks, and that could happen next week. It could happen next year. I don't know when that shift is going to occur, but right now, Yeah, General Motors actually, it looks like a small cap breakout stock. I mean,
a very nice week.
Yeah.
Very nice week. Well, my conundrum is that I have some calls out on GM that are early January, and they're in the money now, and I'm wondering, do I just let them go? I've already made some money in it, or do I roll them out a couple more months with another dollar or two ahead and see if I can get any more cash out of it?
Man, that's a tough one. That's a tough call. Yeah.
And at this point, I've sold some puts against it just to defray from the cost. You sell puts at, I think it's at about 30. I think it's at 36. So I've sold some puts at 32. It's had the move, so it's actually right at this point. I'm paying for the time factor, the time decay factor, because it's above. But the puts are there. They've kind of minimized, that. So
yeah.
But so you really, it's a flip of the coin as far as you would.
Yeah, that's
surmise.
That's a really tough call because you're right at a kind of a key area. It just took out the resistance there at 36.5, and man, your guess is as good as mine.
Okay. How about Lincoln? That's another one in my holding. You think that thing's got any more?
Well, it responded very well to the election.
Oh, of course. Yeah.
And if you are going to put a tariff on Chinese goods, Lincoln's biggest competitors come from China, and actually they taught them how to make that equipment because they manufacture a lot of their own equipment there in China. And so if you get if you do have a tariff on imported goods from China, then Lincoln stands to benefit somewhat from that. Although they have manufacturing facilities in China,
precisely, yeah.
So I'm wondering if they will get some sort of a pass, saying, well, since you're an American company, just bring it back home. I don't know. I doubt it. I doubt it. If they try to ship their own product back to the United States, they might get they might pay the same taxes that a Chinese manufacturer would. So there's so many things that you just can't know. There's so many things that are just up in the air. And by the way, it's typically always that way. This one's a little more interesting because these moves are going to have a much bigger impact on stock prices than a lot of the other things that have been going on over the past 8 years or so.
Intermediate, you'd say Lincoln and GM are moderately aggressive as far as what's going to happen with them or could be. There's not a lot of risk at this point, is there? In those although they both had nice moves.
Well, their trends are currently up, and
right.
that's always a good sign. Okay, but that can change, and this is the thing that I've been putting a lot of thought into this over the past, especially the past few weeks, because it's been 3 years since there were more stocks that make up 99% of the stock market. That's what I'm looking at, basically the Russell 3000. It's been 3 years since you've had more stocks in an uptrend than you have had them in a downtrend. 3 years.
3 years? Wow.
Yep. And that just switched about a week before the election. And it accelerated when Trump got in office. It actually accelerated. So now you've got 2 out of 3 stocks that are in a short-term uptrend, and I'm defining that by the 10-day moving average is higher than the 50-day.
Okay.
So that's my definition. And it's actually reversed now. Instead of 2-to-1 negative, it's actually 2-to-1 positive. There are twice as many stocks, more than twice as many stocks actually. 2/3 of the stocks are actually in a short-term uptrend. And
anything be? I was just going to ask Bill. Could anything be taken from a contrarian standpoint there or not?
Well, if you like standing in front of trains, yeah,
okay,
you could do that. And that's, a lot of people like to do that. I'm sure there are a lot of people shorting it. Look how badly the biotechs have just gotten whooped.
Yeah, I've taken some punishment there.
Oh man, and see that's the but those things sold at prices they should have never sold for. In fact, I put out that a couple lists of the bank stocks. You should see what's happened to some of those things. Now they're selling at 6 or 7 times sales already. The long-term average is between 2.5 and 3. And a lot of those things have really jumped. But there's some risks there. You're looking at a lot of the smaller banks, especially the regional banks that are going to be taken out. The smaller ones, some of those things are selling at valuations that are higher than they were in 2006.
Wow.
And I'm going, yeah, that ain't good. But that's such a small percentage of the overall. In fact, your bigger banks, J.P. Morgan's, Citibank, their valuations are still extremely reasonable. Extremely reasonable. So they get a little bit of boost from some of the economic activity picking up, and you could see those share prices still go up, 30, 40, 50% or so.
Well, that list of the banks that you have is, you think there's still any value out there?
Oh, yeah, there is. Okay. And in fact, it's what's really wild about it, it's kind of tilted now back towards the larger companies who are up, but they're up nowhere near the amount that a lot of those smaller ones went up by. So they've kind of been lapped. And
I was going to say on the smaller banks, I would assume if you're going to buy a basket of them, you put a 10% stop loss on them.
Nope. That's the now that if you're going to trade, you got to trade. If you're going to invest, you got to invest, and those are two entirely different animals.
Well, are those trading or are those investing?
Those would be investing.
Okay.
Yeah, you're going to invest. It's really difficult to trade those types of stocks. It's incredibly difficult to trade a GM or a Lincoln. The old economy stocks are incredibly difficult to trade because they're so subject to the economic pressures, and it's going. The economy changes every day. The numbers change every day. They typically don't put in those big, huge, like 100, 200, 300% runs over a 4 or 5 month time period. That almost never happens with those bigger companies like that. So if you're going to trade, you're doing that with smaller, faster growing companies or companies that are so pathetically undervalued that when they get back to normal, they're 3 or 4 times higher than they should be. Then you can use a stop. But if you're going to when you're talking about these types of companies, these are investments. You got to suck it up. And you're going to put up with a lot more volatility when you're an investor than you would as a trader. In fact, I run a small fund. You look at the volatility of the trading portion of that fund, it's less volatile than the overall market is. Then that's despite the fact that on the flash crash that happened last fall, that I was down 14% in a day.
Wow.
But you look over a longer time period. I started off the beginning of that time period was up about 5%, and it actually went down from peak to trough. It went down about 20% in 2 weeks.
Wow.
Yeah, and now it's back up 10, by the way. But and it's been smoother overall. Not every day. That one day was the flash crash just pummeled me. By the way, I had to stop using stops that I put in the marketplace, so now I have to look at it every day.
Wow. Why, you had to, or?
I had, because the flash crashes just kept taking me out.
Oh, I see what you're saying.
And so now I'm looking at the closing prices. I look at it once a day, and if it goes way down, and by the way, with that type of style, I try not to look at it during the day.
Yeah.
It's hard not to do because I typically look at it anyway. But I make my decision on the closing price, not the daily range, and that's kind of the solution I've come up with to getting whipsawed by the.
I was just going to say one last thing, Bill. The market being what it is it's had a heck of a run in the last say 45 days or so. Are we going to get any slight correction, or?
I don't know. Last year we set a record. In January, it was the worst January in the history of the stock market. Last year.
Yeah, it was dreadful, sure.
Yeah,
sure.
so, all the old rules just don't mean a whole lot anymore.
Okay.
Yep.
I agree. That's why I'm asking.
Yeah, and I'm looking at, when you look at how far the market's come since 2008, it's not up a whole lot. And you look at where it's come since 2000, and it's pathetic. I mean, the market was at 2000 in the year 2000.
That indicates there's more run.
Yeah,
more
I would think so. Valuations are good, too. Hey, I got to take a real quick commercial break.
Okay, thank you.
All right,
Bill.
Thanks for calling. Yep, you're listening to Bill Bullington right here on 1420 The Answer. I'll be back after these messages.
In my dreams, I have
hey, if you missed the show, you heard something you thought you might want to hear again, you can actually look me up on iTunes. It's available there. The show's also on YouTube. There's no picture, because I have the perfect face for radio, by the way. But you can pick it up there. You can also go to my website, and there's a version of it there. It's bullingtoncapital.com, and you can sign up for the workshop coming up here shortly. It's January 12th. There's no cost. It's free to attend. Corporate College does a great job, by the way. That's where we hold the workshops. The first one, the individual stock talk, 6:30. We're going to go for about 30, 45 minutes, take a little break. Come back 7:30, talk about the new year, new president, new risks, and opportunities. There are lots of opportunities. Lots. I mean, I just feel like it's a good time. It's a very good time. I've always feel like it's, there's always something out there. I remember Mr. Burke, one of my mentors when I first got into this industry. He was one of the guys who's been in, for 30 years, and he comes up to me, and it takes me to lunch, actually. Hands me this little statement that he wrote out. And the statement says, you always need to be a little bit bullish. And I get it. You always need to be a little bit bullish. But so I've always been a little bit bullish. Just, easy when you have a name like Bullington, which incidentally, I had a radio caller write me and accuse me of changing my name. Because of the business I'm in. I'm like, really? Nah, I haven't. That's actually my real name. And it's an old one, by the way. It goes way back. But come to the seminar. You can sign up by going to my website, Bullington Capital. If you want to listen to this, you can actually pick it up on iTunes. You can pick it up at the webinar. on my webpage. And, this is I think we're in pretty good shape. And there are risks. Somebody emailed me, and by the way, that's a great way if you want me to talk about something on the radio. I'll be glad to address it. Email bill@bullingtoncapital.com, or you can call us in the office. You can call it. Yeah, you can call the office. The phone number's on the website, but I'll give it to you anyway. 330-664-0700, or you can call in here, 216-901-0945, 216-901-0945. Ask any questions. We're working on a couple things that I am not going to talk about today, but we will be talking about shortly. I think you're going to really like and going to be very helpful. This is a very good time to be an investor. Now, part of the risks that we're going to talk about and discuss, and since I have a very good friend who is very concerned about a lot of things that are happening right now, I thought I would spend a couple minutes to talk more about it. We talked about it a little bit earlier, but I'm going to talk some more about it right now. The risks with paper money, when you have paper money, the way that we do, the way that most advanced economies in the world do right now, in fact, nearly all of them do, the risk is typically not that you're going to run out of money, because every government knows they can literally do the same thing that Germany did in, prior to World War I and just print the money. If you just print the money, you get unbelievably high inflation. And that is incredibly destabilizing. Incredibly. That's the real risk. How are you going to do, what are you going to do in the economy? So we're going to cut taxes and increase spending. Okay. How are you going to control or mitigate the risk of rapid inflation? That's the trick. Nobody's talking about that yet. They will be at some point in time. And I got a question. Somebody wants a question regarding a 401k. Am I talking to?
Yes, Bill?
Yes.
Good morning.
How are you?
I enjoy your show and appreciate your insight. My question is there anything that can be done to reduce the asset-based charge that's associated with 401ks? Yeah.
There are some. Actually, I would go to Fidelity. I work with them on a couple 401k plans. And they've got one of the better platforms out there, in my opinion. There are lots of good platforms out there, but it depends. How big is your business?
Probably between 50 to 70 employees.
Okay, that would be perfect. Because you get down under 10 employees, and it's just hard. It's just very difficult. But when you're at 50, I would say Fidelity is going to be incredibly difficult to beat. And for the services that they provide, I really don't think you can. They have everything. They'll do financial planning. They help you do the asset allocation. They have guys like me that, I come with it or not. I'm an option that can be written off.
So is it more like a flat charge as opposed to a percentage of the total assets?
They have options for either way.
Okay.
Yeah. So they'll work with you. If you want, I'll tell you what. Because I deal directly with the people in the home office. You can call me or email me, and I'll send you my contact information. So that'll get you a lot faster.
All right, I appreciate it.
Yep, no problem. Was that all you had?
That's it.
Okay. All right. Well, have a good weekend.
One.
Yep. Thanks.
You too. Bye.
Bye. Yeah, helps to know people on the inside. That's for sure. Fidelity's got a phenomenal 401k program. I've seen some other good ones out there. I'm not really sure what they're paying right now. So I can't really speak to that. But there are a number of big companies that operate in that, and the thing that they benefit from is the scale, the sheer size. The more assets they have under management, the lower the management fees can be because they've got more assets under management. Now, if you want to try to do slightly better than what you would do in investing, that's what we try to do. Not easy, by the way. And this is another thing. It really isn't easy to outperform most of the professionally managed products. And you won't do it every year. That's not going to happen. If you're going to take an idea, like take, for example, my high dividend model, there are years when that won't perform well. And you go for 6 months or 12 months with a lot of people, and they just out of town. See ya. They trade and go to something else. They don't realize that most strategies that have a better long-term track record will underperform a market cap weighted index like the S&P 500 or even the Dow. Sometimes it'll underperform for 4 or 5 years in a row. And the strategy's not broken. It's just cyclical. That is incredibly difficult for people to accept. And that's one of the things you're going to have to do. If you want to beat the markets in the long run, you got to be willing to underperform them sometimes for 2, 3, 4 years in a row. And I can tell you that is not easy. That is not easy to do. You really have to have a lot of belief in what you're doing. It helps if you understand what you're doing, like exactly what you're doing. When you understand exactly what you're doing, then you kind of know that, it's going to underperform from time to time. It's going to happen. If you understand exactly what you're doing, you can pick those strategies that most closely resemble your own personality when it comes to investing. Now, if you like to buy stuff that's on sale, you're a value investor. You'd be more successful as a value investor. At least that's my opinion. You like picking up bargains, you should probably look at value. You like to make money fast, then you probably want to look at growth or momentum. I would say momentum over growth. Growth and value, growth is actually kind of losing its prominence. They're actually using momentum because it's a lot easier to manage, and it's actually been more successful. A lot of research coming out lately on that, and we've been talking about it, and people have known this for quite a while. The databases haven't gotten quite as advanced as they are now. Even the Chicago Center for Research and Securities Prices, CRSP, they call it CRISP, which is unbelievably expensive, by the way. In fact, you'd probably be better off enrolling in their MBA program to get access to the database than subscribing to it. That is, I wonder if they get mad at me for that. All these people signing up for their MBAs and never going to class just so they can get access to the research database. That's pretty funny. Anyway, I did it again. Just lost my. Oh, I remember. So if you don't have the databases, and those have only been available to extremely large organizations that have lots of money to spend on that kind of thing, then you wouldn't have known. And so what's been happening is the number of large organizations has grown fairly substantially. The data has actually improved. The data points, the quality of the data has improved quite a bit. And now you're starting to get academic research showing that momentum can be a viable strategy. But it's a lot like the value where for several years in a row, it'll actually underperform a market cap weighted index. Now, everybody that promotes a market cap weighted index like the S&P 500, by the way, you can buy an equal weighted S&P 500 and it has a better long-term track record. Okay. So, but those people that promote that have a vested interest in promoting it because it's where they've made most of their money. And if they've always been defending it their entire careers, they're going to go to their grave defending it. That's just kind of how that works. You know, I mean, think about that. And for long time periods, they'll be right. And they just kind of ignore those time periods where market cap weighted indexing has produced negative returns for 10 years or longer. And so I don't like to ignore those periods because, when you come up for retirement, you can't afford to have a 10-year negative time period. Anyway, you've been listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, everybody. Good luck and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.